Being, I don't want to use the word precise, but I'd have to use the word precise. Being precise, knowing what to do with Fibonacci in the financial markets. Knowing what to do with Fibonacci in the financial. So Fibonacci in the financial market is a tool that we use to trade, okay? A tool that is used to trade to help serve as a confluence to a pattern or a method you're trading, okay? That is what the idea of Fibonacci, or that's the major idea of Fibonacci. Now, using Fibonacci to get precise with your trading is giving you more confluence. So basically what we are talking about is general technical analysis in this session, okay? Technical analysis in this session. And we'll be using Fibonacci as our key factor in every decision we'll be making in this session, okay? So in this session, we'll go through what is Fibonacci, okay? An overview of what Fibonacci is. The golden ratio, okay? There's a term, Fibonacci golden ratio. The golden ratio. Fibonacci retracement tool. How to use the Fibonacci retracement tool. Then we would give a firm conclusion on everything we are talking about when it comes to being precise, trading using Fibonacci, okay? So, to the first thing that we have, a general overview of Fibonacci. Leonard Fibonacci is an Italian mathematician who is credited with introducing the influential sequence of figure, which is known today as the Fibonacci number. So Fibonacci is basically mathematics, okay? It's basically mathematics, and it was discovered by Leonard Fibonacci and named after him. It's just an influential sequence of number which applies to our everyday life, okay? The relationship between the number in this sequence, that's the ratio, the Fibonacci ratio, is not just interesting based on mathematical levels, but it appears around everything we do in the physical world, and it is integral for maintaining balance in nature and architecture. Now, when you've understood that Fibonacci is everything we do, Fibonacci applies to everything we do, that means you can apply it to the financial market. This gives you an edge, okay? That if this is being applied in the financial market, there is a higher chance of having a better win rate using this tool. Do we all understand the relationship with this number, how it aligns to everything in the world, everything we do physically, giving it a balance between nature, architect, and also bringing it down into the financial markets? It is also important in the financial market, with many traders using Fibonacci ratio to better structure their trading strategies. Like I have said earlier, right here, it is important in the financial market because it helps you better structure your trading strategy, how you trade the market. If you apply Fibonacci tool to your trading approach, it helps you attain a better edge with your strategy. It gives you a better win rate, accepting the fact that you know how to use it very, very well. Okay, even if it's not very well, you have a certain idea on how to use the Fibonacci tool. Now, in this session, we'll cover the rudiments and concept of Fibonacci tool, and basically, it will be aimed at showing everybody on this session how to use the Fibonacci tool as well as the variables to consider whether you'll be integrating it into your trading strategy or not. Now, I will not bore you with the whole mathematical part of it, okay? I'll excite you with how Fibonacci works in the financial market. So when you understand how it works, how you can apply it to trading, you'll get a better win rate. And like Cyril said, thanks for my strategy. He tried it and the win rate is good. Like, that is just basically it. Once you are able to apply it to a strategy, I use the Fibonacci in every strategy I have. And that is why most of the strategies I share on the sessions always have a good win rate. Your win rate is greater than your loss rate. And once you can apply risk management, as we have discussed previously last week, you have a better or a more, you'll be more advantageous having more wins than losses. Now, let's talk about the Fibonacci golden ratio, okay? Now, this is the mathematical aspect. Don't get bored with it. It is interesting, okay? Very, very interesting. This is just to give you an understanding of how we now brought it to the financial market, okay? It gives you an understanding of how it is brought into the financial market. Now, talking about the Fibonacci golden ratio. Now, although it sounds like a mathematic thing, like I said, you might want to feel it's boring, but it's not. It's majorly how we derived it and brought it to the financial markets. Although it sounds like a math thing, the golden ratio appears everywhere. Everywhere. I said in everything we do in life, everywhere it appears. You see, in geometry, it appears, in art, it appears, in architecture, it appears, in nature, it appears, even in the human body, it appears there. And surprisingly, it appears in the financial markets too. You can use it to trade in the financial market and have a good win rate. You can apply it to your strategy and make better out of your strategy. Understanding when a certain theory applies to everything in life, it applies to the financial market. And after seeing results of it applying to everything in life, there is a tendency, or there is a very high tendency, that in the financial market, the results are there also. Exactly. Cyril says he's a math teacher, and Fibonacci is a math topic itself. Brilliant. And now we are bringing it to the financial market. The Fibonacci golden ratio is derived from the Fibonacci sequence. Okay. Now, in the sequence, each number is simply the sum of the two preceding numbers. That means in a Fibonacci sequence, the two last number is what we had to get the next number. So 1 plus 1 is 2. 2 plus 1 is 3. 3 plus 2 is 5. 5 plus 3 is 8. 8 plus 5 is 13. 13 plus 8 is 21. 21 plus 13 is 34. You see, that's how we get the sequence over and over and over and over again, based on how Leonard Fibonacci has put forward. Now, the unique thing about the sequence is that any number in the sequence divided by the previous number gives us 1.618, or the inverse of the number 0.618. As we get further down the series, okay, you get to understand how we derive these figures once you see the sequence over and over, how you see the sequence in series. Okay, for example, if we have 34 over 55, we get 0.618. If we have 89 divided by 144, we have 0.618, and so on and so forth. Basically, these values repeat itself. That is what we end up getting over and over. And the golden ratio is that 0.618. The golden ratio, the Fibonacci golden ratio, is 0.618. And this is known as the golden ratio. And the theory was used in the financial markets to create the Fibonacci retracement too. Now, let me give you a very good example. Yes, read one. The previous sessions are on our YouTube channel, okay? Okay, previous sessions are on our YouTube channel. Now, let me give you an example. If you have a car, if you have a car, if there is no engine in the car, will it work? Yes or no? Will it work? There is no engine. You just have a car, but it doesn't have an engine. Will it work? I'd like to get a lot of response to this. If you have a car and the car doesn't have an engine, will it work? Yes or no? If you have a car and it doesn't have an engine, will it work? Yes or no? Okay, everybody says no, 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 no. Okay, great. Now, if you have a car and there's an engine in it, will it work? You have a car, there's an engine in it, you fuel it, you check all the whole thing, it's good. Will it work? Now, let's bring it back to Fibonacci aspects. If we don't have a golden ratio, which is 0.618, based on Leonard's theory, will everything be balanced? Based on geometry, based on art, based on nature, even the human body, will it be balanced? Yes or no? Just hypothetically speaking, okay? No, exactly. Now, this is the theory of the golden ratio. It is like the key to every single thing we will be doing in this session. Once you understand that 0.618 is that level you should keep your attention on in the financial market, on that Fibonacci tool, you will gain a better edge when trading. Do we all get the concept now of golden ratio? Okay, of how it is like the center of all things working. Okay, do we all get the logic now? Okay, let's use another example. If you have a Bluetooth speaker, okay, and the Bluetooth speaker doesn't have a power on button, can you connect your mobile phone to it to play music? Can you connect your mobile phone to it to play music? The answer is no. But if it does have a power on button, there is a very high tendency that you'll be able to connect your mobile phone to it and listen to your favorite song. Okay, this is just the logic of it being the starter or the key start, the on and off switch. That's just what it is. That's how the golden ratio of Fibonacci is. It's like the center of every single thing based on Leonard's theory. Do we all understand everything I talked about? Just from the golden ratio down to from the general overview to the golden ratio. Do we all understand the logic there? I'd like to get a lot of response to this. Do we all understand the logic there? I'd like to get more response. I'd like to get a lot of response. And I just sent out a poll, okay? I just sent out a poll right now. Just go to the poll section. I asked the question there. Simply respond to it. Let's now move all our attention to the polls. Let's respond to the questions in the poll, okay? It's the center of everything. Now let's bring the golden ratio to the polls, okay? Yeah. Now let's hop on to the next one. The Fibonacci retracement tool, okay? Now I'll explain it in a very simple manner so everybody has to understand. Fibonacci retracement tool. A Fibonacci retracement tool is used in a trend to pinpoint for how long price will go against a trade before continuing in its right direction. It is to pinpoint for how long price will go against a trade before continuing in its right direction. That is what a Fibonacci retracement tool is. Fibonacci retracement tools are considered a predictive technical indicator since they attempt to identify where price may be in the future. Now, the word predictive there means we will be considering the golden ratio whenever we are using the Fibonacci retracement tool. That means every single time we are expecting price to trade away once it gets to the golden ratio. I will show you a very, very good example on the charts very soon, okay? It identifies this by using a horizontal line to indicate the possible support and resistance level where price could potentially reverse direction. Now, on a Fibonacci retracement tool, there is always line on it, and those lines act as potential support or resistance, possible support or resistance. And those possible support or resistance are derived from the golden ratio, the Fibonacci sequence itself. And it gives you a heads up, okay, a heads up that this is where price is likely to continue its direction. This is where price is likely to reverse and continue moving up if it was going up, or reverse and continue moving down if it was going down. Now, the Fibonacci retracement tool is best used in a trending market. I can't overemphasize this, okay, or underemphasize it to be precise. See, for you to get the best or the max use out of your Fibonacci tool, you need to use it in a trending market because that is where the result lies. You want to continue with the trend. I always say this, the trend is your friend, okay? The trend is your friend. Don't try to catch top and bottom. Just try to continue with the trend. Trade along with the trend direction. That is how you profit from every single move the market direction is giving off. That's how you profit from the moves the market direction is giving off. Now, how to use the Fibonacci retracement tool? Before we dive deep into this, I would like to share my screen, my MT4 screen, and show you guys the Fibonacci retracement tool. Or I will talk about this first, then show you guys how to use the Fibonacci retracement tool. How to use the Fibonacci retracement tool. Now, the theory is that After price begins a new trend direction, once price starts going in a certain direction, price will retrace or return part away back to the previous price level before resuming in the direction of the trend. Okay. Now, if you remember, and you were on this session when we talked about market structure, okay, when we were doing those in-depth technical analysis session, remember we said price can never just go up, like just go up in a straight line. Price has to go up, down, up, down, up, down. And even if price is going down, price can't go down in a straight line. Price has to go down, up, down, up, down. We discussed this. We said impulse and correction, expansion and retracements. Okay, impulse and retracements, expansion and retracements, impulse and correction. We talked about all of these things. And the major idea is to go long, which means to buy on a retracement at a Fibonacci support level when the market is trending up, and to go short, which is to sell on a Fibonacci retracement at a Fibonacci resistance level when the market is trending down. That is basically how to use the Fibonacci tool. And let me show you an example. Before we get to the 3-step rule, let me share my empty full screen so we can all see it properly. Trying to share my screen in a few minutes. Get to see my MT4 right now. Okay, sharing my screen and right now. Okay, if you can see my MT4 screen, please do let me know. Can you see my MT4 screen? Can you see my MT4 screen? Yes or no? I'd like to get your, okay, just one person. Okay, yes, great, that works. Now, this is my MT4 screen and this is USD CHF. Okay, so I'll be using the 4-hour majorly to explain this. Okay, I'll be using the 4-hour majorly to explain this. Now, we said we use it in a trending direction. So let me zoom out a bit. Let me adjust this. Yeah, okay, great. Now, we said we use the Fibonacci tool in a trending direction. Okay, if the market is trending, we said that's how we use the Fibonacci tool. And let's look at this. Before I hop into the whole trend, I said a market can't just continue going up. Okay, the market can't just continue going up. Let's adjust this. Turn off the raise. Okay, yes. We said the market can't just continue going up like this. Okay, the market has to go up like this. After creating an impulse leg, it has to retrace, then create another impulse leg, then retrace, then create another impulse leg, and it has to still retrace. So just impulse, correction, impulse, correction, impulse, or impulse, retracement, impulse, retracement, impulse. They call it a law of name. Don't just get worked up because of the name. Or they call it expansion, retracement, expansion, retracement, expansion. But we're using impulse and correction majorly. Okay? Impulse, correction, impulse, correction, impulse. This is how the market works. Even if it's a downtrend, even if it's a downtrend, this is how the market works. Even if it's a downtrend. If it's a downtrend, we have impulse, we have correction, we have impulse, we have correction, and we have impulse. So this is how a downtrend works also. This is how it works in the financial market. Now, to show you this clearly, let's see it in this scenario. Okay, let's look at how price moved here. Okay, so I'll be using the factors we've been talking about also in the past. Okay, so it's not new. I'll be using the factors we've been talking about also in the past. So I don't want to zoom out my screen this way. Let's just do this. Okay, so we have a uptrend here. Okay, we have a low, we have a high, we have a lower high, sorry, higher low, higher high, higher low, higher high, higher low, higher high, higher low, but there's no new higher high. Okay, we failed to break above this old high, so we can say market structure is now bearish. Okay, we can say we are now in a bearish direction right now with respect to this old low broken. Now we are saying we are in a downtrend now. All we'll be doing to continue trading in the downtrend direction is putting our Fibonacci 2 from the swing high to the swing low. No worries at all. I just let me change the color to black. Okay, let's make the color black so we can all see it. Okay. Okay, so we changed the color to black and we said from swing high to swing low because we are trying to continue trading with the downtrend. Now look at where price went to. We have 4 major number on the fib. We have the 23.6 derived from the fib sequence. We have the 38.2 derived from the fib sequence. We have the 50% derived from the fib sequence. I have the 61.8. Now what I want to pinpoint is look at the 61.8 fib level. I will try to show you that using this tool. Okay, show you this using this tool. Okay, look at what happened at the 61.8 fib level, that blue area. What did you see at the 61 point? You see how price rejected, okay, and decided to start going down at the fib 61.8 fib level. Can you see how interesting it gets? How price decided to reject from the 61.8 fib level and go all the way down. Now let's just delete everything on this chart and I'll show you in another scenario again. You see how this worked for the down scenario. Now let's go and look for the bullish scenario. Okay, so we are in an uptrend here. Let's see. Okay, this is a downtrend changing to an uptrend. Okay, so we have a high, a low, we have a higher high and a higher low. Okay, now look at it working perfectly. Swing high to swing low, sorry, swing low to swing high, this low to this high. That is where we put our fib, and look at what the market did. Market came relatively close into the 61.8 fib level, which is relatively close to the 50, just within this range. Okay, within this 50 and 61.8 fib level range. See it. And what happened? Look at what price did. Price just decides to go higher from there, and price went up to 115 points. Now you could have capitalized on every single of this move to this high just using the fib. Now you see how easy it gets. Now let's go back to the slide we are using and I'll show you how I knew it's supposed to be from swing high, swing low to swing high, and swing high to swing low. I'm sharing my screen right now. So I best believe you can see my screen. If you can see my screen, please let me know. Can you see my screen? If you can see my screen, the slide, please let me know. Can you see my slide properly? Okay, great. Now, the 3-step rule. How to draw your Fibonacci retracements tool. Remember, we said that the idea is to go long or buy on a Fibonacci retracement at a support level when the market is going up. You see, when the price was going up or when market was going up, we were looking for buying opportunities using the fib. And also, when the market was going down, we were looking for selling opportunities using the Fib. Now, the 3-step rule, drawing your Fibonacci retracements tool, is a 3-step process. Very simple. It's a 3-step process. It's nothing difficult. I hope we all have our pen and paper. In an uptrend, okay, in an uptrend, identify the direction of the market. Make sure it is in an uptrend. Identify it is going up. The second step, attach your Fibonacci retracement tool on the bottom and drag it to the right all the way to the top. From bottom to top, remember, from swing low to swing high, bottom to top. That's how you use it in an uptrend. And step 3, monitor the 3 potential support level, which is 0.236, 0.382, and 0.618. Now, the reason the 50% fib level was not made mention of here is because of the 50% level is described as equilibrium, okay, a balanced area. Looking for entry triggers at equilibrium isn't really advisable. That is why when I marked out for the uptrend on USD CHF, I made sure that the area we used was stuck in between the price level for 50% and 61.8. In that way, you can actually capitalize on the trade there. And I'll show you an example again for an uptrend to explain the uptrend stance properly. We'll use another financial instrument this time. Sharing my MT4 right now. So let's use USD JPY. Let's use USD JPY for an uptrend now, okay? Now we have this sweet uptrend, okay? We have this sweet uptrend, yeah? So let's hop into it. This is the lowest point. We said from bottom to top, okay? From bottom to top, from bottom to top, from bottom, still the same bottom to top, from bottom to top, from bottom to top. So that is all we'll be doing now, okay? Now let's take our fib. The direction, okay? So if you are looking for a direction, you can't pinpoint your fib, your market direction. Just add a 50 moving average to your chart, okay? From here, we've seen changes that price is already bullish, okay? So you can gladly pick your fib from bottom to top. And look at what happened. We came to the what? Range between 50 and 61.8, which is actually a very good buy area. See, right here. Right there. You could have made profits on this buy. Let's check how many pips that is. So let's say you got your entry somewhere around here and you followed it to this stop, okay? You would have made 78 points. 78 points. If you entered 1,000 naira per point, that's 78,000 naira. Good money right there. Okay, let's go. Let's delete this one, or let's just adjust this one to bottom to top. Look at it again, 61.8. Our price stayed there before we went higher. 61.8 level right there. See how price went higher from there. See how price went higher from there. Also, from bottom to top, this is the highest point here. So bottom to top, and look at how perfectly it rejected from the 61.8 fib level. From bottom to top. Look at how price came back to the 61 point. It even aligned with the 50%, with the 50 moving average, with the 50-day moving average right there. Aligned there, and see right here. From bottom to top. Now, only this came to the 50%, which was equilibrium. Now, the only reason you would consider the 50% is because of the projection, the price movement initially, the last bullish candle, which gave you the significance for a buy, was at the 38.2 fib level. So we can consider this. And you see, immediately this old low broke, the concept of market structure, break a market structure, we started going down. Now you see how many times you would have gotten into a trade. You'd have gotten into first trade, second trade, third trade, fourth trade, fifth trade, 5 trades, and you would have initially made an average. Let's just make it an average. An average of, an average of 50 to 60 pips per trade. Okay, 50 to 60 pips per trade. You'd have made 50 to 60 pips per trade. 50 pips here, 50 pips here, 50 pips here, 50 pips here, 50 pips here. That's 5 times. You had 50 pips 5 times. That's amazing. That's amazing. That's 250 pips in all in the month of May to June. Okay, all in the month of, this is May 6th and this is June 1st. Okay, so this is even all in the month of May. Okay, oh sorry, July 1st. Okay, May to July, it have made 50 pips, and this is relatively more than 6% of your trading account. If you remember, we talked about making percentages of your trading account every month. Imagine just in May alone, you would have made 50 on a whole 100 points. Okay, 100 points, which if you capitalized on it properly, this would have been more than 6% of your trading account. If you capitalized on this one from all these 3 trades in June, this would have been more than 6% of your trading account. Just knowing how to capitalize on trades better. Just knowing how to capitalize on trades better in the financial market using the Fibonacci tool. It happens, it repeats itself over and over and over again. It happens to repeat itself over and over and over again. Just understand how to use the Fib tool. Okay, so about the uptrend, does anybody have any question? I'll take the question now so I can be able to dissect it and give you the proper idea towards it. Okay, any question based on how to use Fib on the uptrend as I have explained and you've seen it work? Okay, no, I'm not saying there's no lot size. I didn't give a certain lot size serial. I'm just saying if you capitalized on it properly, you put into consideration everything we discussed in the last class, which was risk management, you would have made more than 6% of your trade, of your initial capital on every of this trade, or every single piece of this trade. The best leverage to start with as a beginner is 1:200, and that's what we offer you at AG Global Markets. Our accounts, or all our trading accounts, our standard accounts basically is like a zero spread account. The spreads are very tight and we don't charge you commissions. The swap fees are very small also. And the lot size for beginners, I believe, based on your balance, should start from 0.01 to 0.02. It is basically on your MT4 platform. Okay, it's on your MT4 platform. Just the Fib tool is already there, so there's no need to set it. All you just need to do is click on it on the top right here and place it from swing low to swing high. Then wait for price to come back into the 61.8 and catch your pips. Okay, just take your money out of the markets, and that's just the way it's done. Simple and easy. Okay, so let's go back to the slide and talk about using the Fib in a downtrend. You see how it works. This is not theory, this is it working in real time. Okay, even though it is insight, but it works in real time. I've used it on sessions with you guys real time, and we can all see how it worked, and it's still working till now. Okay, so now in a downtrend, it's just the opposite of the way you are doing it in an uptrend. You need to identify the direction of the market, which is basically downtrend. Attach the Fibonacci retracement tool on the top and drag it to the right all the way to the bottom. Okay, top to bottom. Remember, uptrend, bottom to top, downtrend, top to bottom. All you need to do is to monitor the 3 potential resistance level: 0.236, 0.382, and 61.8. I said the 50%, the reason we don't consider it is because of it is an equilibrium level. Buyers and sellers are there, so there's a tendency that it might fail. Okay, so we need to see it now straight to either the golden ratio or any of the Fibonacci sequence above. We'll talk about the downtrend example soon. Let's just go to the conclusion. Okay, now, truth be told, Fibonacci approach to trading applies to every trader, especially beginners. You should master how to use Fibonacci. It gives you an extra level of insight to potential market turning points that may not be clear to you at the first glance. See, have you ever been in that situation where you look at the market for like 10 minutes, you will not see anything? You won't even know what to do at all. Have you ever been in that situation? If you've been in that situation, just type yes in the chat box. If you've been in that situation before, type yes in the chat box. You stared at your screen, your device, you stared at a chart for good 10 minutes and you've not seen, you couldn't devise or you couldn't deduce anything to do on the chart until you had to add a tool to that chart. You see, many people just enter the market just because of price has reached a certain level on the Fibonacci ratio. But like I said, that is not enough. It's not enough to just wait for price to come to 61.8. If you noticed when I was explaining the uptrend, we can notice that every time price came to 61.8 or any of the Fib sequence, it was aligning with the moving average. And I'll show you again also. You see, it is better to look for more signals, more confluence before entering the market, such as Japanese candlestick reversal pattern or an oscillator that crossed or a moving average or something to consider addition. Always apply your Fib or a Fibonacci tool with other tools to get the most potential results. Okay, and also always consider risk management strategies when you are using any of these indicators. A Fibonacci is not just a tool, it's an indicator. Okay, it's not just a tool, it's an indicator because it also indicates possible turning points in price. It gives you an idea of where price should reverse from. It gives you an idea of where your trigger should be, your entry trigger should be. This is all it takes. Finding more confluence. Okay, see, trading is if we talk about a trading strategy, a trading strategy is just 2%. Further confluence with that strategy is the rest of the 99%. This is just when it comes to trading strategy alone. Further confluence to that your trading strategy is 99% because your strategy can't do it alone. Why do you think whenever you analyze, you have to ask people what they think? That is further confluence. Why do you think whenever you analyze, you have to add the Ichimoku to it? It is because of it serves as further confluence. And I hope we all understand how or the major role confluence plays, even if we are using any tool in the financial market. So this brings us to the end of today's session. Thank you for joining me. I remain your host, Akinwale Chibuike. But before we end the session, let's talk about in a downtrend and also show you how price reacted with the moving average every single time it came to the 61.8 Fib level. Okay, let's quickly see that. Yes, you will surely get a replay. Let's see it. Okay, now let's look at the screen. Look at every time price was at that 61.8 Fib level. Thank God I boxed those levels. There was a certain reaction from the moving average. If you had a smaller average here, let's say we have a 25 moving average, but let's keep it at the 50. Yeah, you didn't get the reaction. But if you look back in time, we had previous support on resistance here. Okay, resistance now turns support. So this was further confluence. If you are using Fibs with confluence, you would have gotten your entry. You would not need the moving average here. Now, look at this one right there also. The moving average give you the trigger here. After the Fib give it, so you would have entered your trade here. This right here, if you are using support and resistance, see, should have give you an entry trigger because it is resistance, 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 support, support, expected to turn to support. Now look at this, how it's aligned with the moving average here. See, into the 61.8 moving average bounce away, 61.8 moving average bounce away. You see how it works, how it easily works. So let's delete every object on the chart and let's talk about the moving average and the Fib in the downtrend. Okay, so considering the rule I talked about, break a market structure here. Okay, we had a break in market structure here. Price is significantly bearish to us now. Okay, price has given us that trigger that it's bearish. So we said from top to bottom. Now, first thing is there's a tendency we might not get a good trigger here, but we got the trigger at 23.6, which is still one of those levels we have to watch. But the most interesting one to watch is the 61.8. Okay, and the reason I will be using this 27 23.6 is because of it's aligned with the moving average. Okay, moving average rejected around that area, so it was good stuff right there. You could have capitalized on this 50 pip move. I'm sure it is 50 pip. Sure, it is 50 pip. Let's see. You can't really see it properly. Yeah, around 50 pips. Nothing bad about that. 50 pips. Sorry. Let's just adjust this now from top here to bottom. See what we had right here. We had price trade higher than the 61.8 fib level, but understand that this was a free area and this was the 61.8 fib level. It aligned with the moving average, so we'll be watching this area for our trade. Okay, you might have had a little bit of drawdown there, but still the area held and it aligned with the moving average. Now look at this high to low. Okay, high to low. Still the same 61.8, but you might have had a bit of drawdown. Okay, a bit of drawdown. A bit of drawdown, yeah. You might have had like 20 pips drawdown there, but you would have still entered the sell because it aligned with the moving average. And also, if you are using support and resistance, you know this was previous resistance, support, resistance, yeah, sure. Now turned resistance here again. If you had looked at it from this angle, you might have had a loss here because you would have hopped into the trade here. You might have been in profit for a while, but your stop loss would have hit. So imagine you had, imagine you had 4 trades. Okay, let me mark that last one out where we had the loss. Yeah. You had 4 trades, okay? Remember, you had 5 consecutive trades here. And you have 4 trades. You were able to profit from 3, but lost 1. Did you lose or profit initially? Let's now consider everything. We had a total of 9 trades. You won 8 and you lost 1. Did you lose or profit from it in total? Just using the fib. Did you lose or profit from it in general? Okay, everybody's saying profit. Anybody think they lost? Anybody? I'd like to get a lot of response though. I'd like to get a lot of response on this. Okay, profit. No, you can use the fib on any time frame of your choice, but I prefer to use the fib on the 4-hour because I majorly swing. That's why I use the 4-hour. Okay, you can use it on any time frame. Just look for tops and bottom on any time frame you're using it and capitalize on it. Okay, do we profit or loss initially? Okay, now the truth is it's a rhetorical question. See, you can win 9 trades consecutively and just lose 1. Okay, you can win 8 trades consecutively and lose 1, and you lose everything. Now, let's talk about what we discussed yesterday or on Monday, which is risk management. Okay, and how someone might have lost a lot of money from this. He saw Fibonacci working consistently on 8 trades. This might be that trade where he decides to go all in to back up the brinks and use all of his capital, and just without using proper risk management, he ends up losing all the profits. So yes, it could have been a loss, and yes, it could have been a profit. But all the same, use good risk management. Use confluences. Okay, there was no confluence here. Another thing why this failed, there was no confluence here because the resistance was still above. That is just the idea of Fibonacci, and I hope we all were able to grasp and understand something from it. Sharing my screen right now, and all in all, like I say always, it's not about coming to the sessions, it's about putting into practice everything we've been discussing.